David Spika is Chief Market Strategist over at Turtle Creek Wealth Advisors. David, we've been talking about this idea of a possible pullback for months, if not quarters at this point. The path of least resistance has been to the upside. What keeps it going?
Well, a couple of things, Dom. You've got strong earnings growth and earnings revisions going higher, a still resilient consumer, and you got the Fed getting ready to cut rates maybe as much as 100 to 125 basis points over the next 6 to 12 months. Those are all going to be tailwinds for the markets, and we're still bullish here.
If you are still bullish, has it been the bullishness on those maybe 7 to 10 stocks, let's call them, in the marketplace that have been driving a lot of the returns? Or is it the case to be made right now that in the case of a possible hypothetical Fed rate cut cycle, that other parts of the market will be the better catch-up trade?
Great question, Dom. And we have seen broadening out of the market. So other companies are starting to perform well. It's not just the Mag 7, but a steeper yield curve, which is what we expect as the Fed starts cutting rates, signals cyclical economic growth. And that means some of these more value plays, some of these more consumer and cyclical related companies should start performing better.
If that's the case, and it is that broadening out, and we are looking beyond, David, the Magnificent Seven trade, the big tech, media, and telecom trade, what parts of that economically sensitive or cyclical part of the market will be the best values and the best returns in the next 6 to 12 months?
Well, one name we like is in the financial sector is American Express. They're going to benefit from greater net interest income as we see more yield curve steepening. They're growing earnings better than 10% a year. They had a great second quarter, and they're really growing in the younger generation. They saw 40% increase in spending among Gen Z and 10% increase in spending among millennials. They're going to have their Platinum Card refresh, which will provide non-interest income growth. We like that name, and we think a lot of the financials are well positioned.
And in addition to that, if you are talking about lower interest rates overall from the Fed, I can imagine that many parts of the interest rate sensitive part of the market are going to respond as well. So what about other parts of the market that are geared towards those lower interest rates outside of the banks?
Well, the home builders have been rallying since May or June. They were heavily oversold. And a name we like is Lennar. They're vertically integrated with development, construction, and financing. And clearly they'll do better as mortgage rates come down. They've got a great balance sheet, great scale, and we feel like they're very well positioned to grow from this point forward, particularly given their very reasonable valuation of 14 times future earnings.